So picture this. You run your own business is booming, cash flow is great. But you walk into a bank to get a mortgage and they look at your tax returns and say, sorry, can't help you.
Ugh, the classic self-employed struggle. It's like, I have the money, I promise, but the tax write-offs make it look like you don't.
Exactly. It feels like fitting a square peg in a round hole. But today we're talking about the solution to that headache. Bank statement loans.
Okay, so break it down. What exactly is a bank statement loan?
It's pretty much what it sounds like. Instead of relying on W-2s or those tax returns where you've legally minimized your income, lenders look at your actual bank deposits over the last 12 to 24 months.
So they're looking at real cash flow rather than taxable income.
Bingo. It's part of the non-QM or non-qualified mortgage space. It doesn't fit the standard government box, but it's a lifesaver for business owners.
And the timing on this is actually pretty interesting right now, isn't it?
It is. We're looking at data from late 2025, where rates have eased a bit. Freddie Mac had the 30-year fixed around 6.22% recently.
Which is down from the highs of the previous year.
Right. And when rates dip even a little, your buying power jumps. For self-employed folks, this isn't just about rate shopping. It's about actually qualifying to get in the game.
I imagine the underwriting is different, though. They don't just take every deposit as pure income, do they?
No. It has to be prudent. They usually apply an expense factor. Basically, they look at your deposits and say, okay, this percentage probably goes to business overhead and count the rest as income.
That makes sense. It's realistic. They know you have bills to pay, but they aren't punishing you for tax deductions.
Here's the other cool thing. It's not just one type of loan. It's like a menu. You've got your standard 30-year fixed, sure.
But I've heard about 40-year terms, too.
Yes, some programs offer 40-year fixed terms to lower that monthly payment, or even adjustable rate mortgages, ARMs, if you want a lower rate upfront.
It really allows you to structure the debt to fit your actual business life. What about interest-only options? I know some entrepreneurs love those for cash flow.
They are available. You can pay just the interest for a set period. It keeps your payment lower initially, which is great if your income varies month to month.
But the trade-off is you aren't building equity during that time, right?
Exactly. You have to use it intentionally. It's a tool, not a free pass. But for a commission-based earner, that flexibility is huge.
Let's talk costs. Because these aren't standard loans, people worry about the fees.
Right. Are they super expensive?
Well, you have options. You can pick a lower rate but pay higher closing costs, or take a slightly higher rate to keep your cash in your pocket.
That's smart. If I'm a business owner, I might want to keep my liquidity for the business rather than dumping it all into closing costs. So is this mostly for buying new homes?
It's huge for buying, especially in high-cost markets where you need a jumbo loan size. But it's also great for refinancing.
Like consolidating debt?
Exactly. If you have high-interest business debt, you can refi your home using bank statements to qualify, pull out cash, and wipe out that debt. It's about cash flow management.
Who is the perfect candidate for this? We're talking freelancers, consultants, realtors, gig workers. Basically anyone whose tax returns don't tell the whole story.
Right. But remember, it's not magic. You still need good credit, reserves, and a down payment. It's not no documentation, it's just different documentation.
A crucial distinction. You still have to prove you can pay.
The bottom line, if you've been told no because you're self-employed, ask about bank statement loans. The market is evolving.
It turns I don't qualify into here's how we do it responsibly.
Exactly. Just make sure you work with a pro who knows how to package these loans properly. It makes all the difference.
Great advice. Thanks for breaking it down.